I'm on mute. Hello, and thank you for joining us today. We are talking about the developer's dilemma. So the developer's dilemma is something that came out of the conversations with a lot of my clients who are developers and trying to come up with a missing link on how they can improve their business, how they can improve their bottom line, increase the number of deals. So the best place to start with this really is looking at both the traditional way that developers have used in order to get the funds to do the development, as well as two alternative ways using syndication. So let's pull up a spreadsheet that I've put together here. So this first column here goes through what most of you know is just a regular deal. So you're going to take a loan out, and I've made up all these numbers. They're based on just things that I've seen around. So project cost of 10 million, developer fees at 500,000. So financing fees, this is your normal loan. So a 70% loan as a construction loan at an 8% interest, which I'm not sure you could even get that right now. But nevertheless, we'll use that for it at 2 points. Gives us a cost of $735,000. A normal sort of sales proceeds, just around 25% above, gives us at the end of the day an ROI of 65% to the developer, nothing to the investor at this point because we're not doing it that way yet. And so sponsor profit of 6.4 million. Now that's a great profit, but it's our ROI is 65%. In order to do this deal, you're out of pocket almost $4 million in order to make this happen. And I'm not counting time. I'm not doing time value of money. It's for this purpose, it's overly complicated. So this is just a very, very vanilla $10 million development deal on any kind of product with just a normal kind of spread that I see a lot of times for profits. So what happens when we switch into the world of equity? So let's decide, okay, banks are difficult to deal with. I hear that from my developers all the time. It takes them a long time to get the deals done. It takes them a long time to do it. And I don't have the control over the funds that I ultimately would like to have. So what if I raised purely equity and put a deal together myself, not even touching the bank? So this is kind of like one far extreme way to go, but it yields good results. There are some challenges, though, that we'll talk about along the way. So same cost structure, same everything. Oh, I should point out, as out of the 6.4 million, back to the loan, this developer cost, it was actually kind of just baked into what you were getting anyway. So it's not like there's an additional $500,000. This time, though, that $500,000 is going to come back in because it's money that's being paid for by the syndication. Total cost of about $30,000, and it's probably a little bit less than that. I wanted to be a little bit more conservative on my guess. I know my fees as an attorney are certainly less than that, but there's other costs that you have as well, including your state blue sky law filings. Maybe you have accounting fees. Maybe there's fees, other fees that you have to pay, or marketing costs in order to get, say, to spend $30,000 to put this together. Then you've decided an extremely generic split of an 8% preferred return with a 70-30 split. I did this again just for pure ease of calculation. So we have the same essentially net cost at the end of the day, and then the sponsor's kicking in $1 million here. it's vastly less than the amount being kicked in by the under a pure loan scenario, but it's still there. That means that there's a raise of $9 million, which I'll circle back to in a minute. Same sale proceeds. This time you're doing a return of all the capital and sharing out that net proceeds. They get a preferred, your investor gets a 21%, which probably is okay. And then the sponsor gets a return on investment of the $1 million of 140%, and makes a profit of almost 1.4 million. So two thoughts on this. So first thought is that we've got a healthy profit here. That does include the $500,000. But what we also have, which is vastly less than the 6.4, but you're not investing nearly as much. You're investing almost $3 million less into doing the development, which means that you could do another project and another project and another project all at the same time at a much higher ROI. So it's the ability to, for what I believe is get that ROI as high as possible. And then the amount of that just means more deals that you can do because you're less out of pocket if you've got a higher ROI. If you're only stuck with one deal at a time, no matter what, anyway, maybe something with a pure equity deal would be okay, or even just doing it alone, just to get that higher dollar amount, even though your return isn't as great. It's still a very good return, but nothing quite like what it would be outside of that. What most developers that I work with do is sort of a blend between equity and debt. And so what this does is it drives down the out of pocket. I just put in a simple 20% of the 20% of the money raised coming from the sponsor, rather than making it $1 million. Or I wanted to show that it could be less. Obviously, I could drive the numbers to 0 and you'd have an ROI of infinite, but that wouldn't really tell you much of anything. So I thought a reasonable number that I oftentimes see is somewhere in that 10%, 20%, even 30% range that most developers are kicking in themselves as part of their equity. So that gives the investor an incredible return because you still have this loan scenario where you're getting a 70% loan, but now instead of kicking in that 3,885, now it's coming from a combination of the sponsor and the equity. So my raise now is only $3 million instead of $9 million. So it's much more approachable, certainly on the first deal, as you build up a track record of doing developments through syndication. Is $3 million is much easier to raise, obviously. The loan amount's the same. So, and then your ROI is through the roof, and your profit is still a little bit higher than just all equity, mostly because you've driven down your out-of-pocket costs, and because the returns are pumped up higher because of being able to just pay off this loan rather than have to do the split with the sponsor. Now, one thing I used to talk about with people when I was coaching on how to do syndication is an idea called levers. So there are certain things in every financial analysis which lever up the return, and the goal is to find out what can lever up the return for you without making it a significant impact to your investors. Things like taking on debt, taking on some debt in order to do that. While it doesn't address the difficulty of the bank's concern, it certainly does address the concern of being able to do more and more deals. So certainly 783,000 is a lot easier to do multiple deals at a cost rate of that than if you have to come up with almost $4 million at every deal. So the point of this really is that there are these different mechanisms in order to structure that development deal. And many times syndication is a really powerful tool to raise funds. Also, it's a great way to raise market awareness of who you are as a developer anyway. And you make more money syndicating yourself than otherwise. What it doesn't, what I didn't put here was any kind of fees whatsoever, which would also increase the amount of money that that the sponsor would make in terms of it. But this is really just a principle of using other people's money here, both a bank and investors, in order to get the maximum profit. So that is the three different ways to look at raising doing a syndication. Doing a development project with a syndication. In terms of when you are looking at a deal for the first time, and when you're doing an analysis of, well, should I syndicate it or do this? This is really the calculation that most of my clients go through. It's okay, what's my cost of funds of doing it through the bank? What's my cost of funds doing it through the equity channels? Can I raise enough money in equity in order to do it all or some, or what's that balance and that trade point? Many times it also is easier to get financing when you push down the loan to cost ratio. So pushing it down to the 70% or the 50% mark becomes much simpler to qualify for, and it gives you a little bit more control over when funds are going to be paid out. So the calculations that I typically use, ultimately, at the end of the day, I really care about IRR. Internal rate of return, to me, is the most important mechanism. In a development deal, I'm probably balancing both regular IRR as well as the MIRR, which is a periodic basis of IRR, which is a little bit more granular. I don't think it's as helpful for a marketing purpose because most investors don't understand what MIRR is, let alone IRR, and the percentage on MIRR tends to be lower. But IRR itself, or MIRR, is probably the most useful tool in order to see if this is a deal that you should go into. Making sure that, can I get my investors for a development deal above a 20%? And we'll go through what sort of percentages you need to be thinking about in the future for your investors. But can I get that 20% or more for my investors? At the same time, am I making enough money as the developer and as the syndicator in order to maximize the use of my time and make sure that it's worth it to me to do that? The other useful figures is cash on cash to some extent, more just to get a gauge of what the effectiveness of my dollar spend is. Mostly from the sponsor point of view, I don't think it's a very useful metric from the investor point of view, because they're not seeing really the loan cost. They're seeing the cost of the investment, and they're seeing what the expected return is. And the other maybe return on equity, which is just slightly different than ROI. So I probably base it primarily on IRR and then go to return on equity next. In terms of that return on investment or that return on equity that most clients or most investors are looking for. So a lot of it depends on the risk reward ratio. So let's look at a whiteboard. I believe that there is sort of actually, I like this to be risk. If this is risk and this is reward, in a perfect world, it goes up like that, right? The higher the risk, the higher the reward. Development is generally considered to be a much higher risk asset class to go into. If I'm investing down here in a stabilized asset, I'm expecting at the end of the day, I've still got a building. It's still insured. I still can get tenants for it. It's very, very simple to do. I've got something, right? At the end of the day, there's still an inherent value in real estate that's already constructed. When we start doing developments, we start thinking about, well, there's governmental risk. There's finance risk. There's supply risk, certainly now. There are all these other risks that put not only the timing of your project at issue, but even the financial stability of it as the issue as well. If you're not able to complete the project in time, the bank decides to call the loan, that's a huge risk. Everything's going to start falling apart. If there's a financial freeze, if there's some problem with the supply of money, it's going to be much harder for you to move forward in the project, even though you want to. Or if the supplies just aren't there, or the tradespeople just aren't there in order to do the construction needed, it's just going to put all of your project at risk. So it's a higher risk, higher reward. That said, I think a stabilized asset needs to be in the 10 to 15% range, probably closer to 15 at that today's point, as long as it is a good market, and that's a 15% IRR. In terms of development, I think the number has to start with a 20. If it is a investment into a single deal that's pure equity, and there is a track record, but not a huge track record in terms of I've built a huge number. I have a huge portfolio of properties I built. Some of my clients have built a lot of stuff and have been doing it for 20, 30 years. And they certainly have a much lower need. Investors need to get less of a return because they're less of a risk. If it's a totally inexperienced person, there needs to be a very, very high amount of an IRR that's going to be given, probably in that 50, 60%. Certainly also depending on the area, if it's in a tertiary market or a market that suffers declines in certainly in 2008, or if it suffered declines in 1992, those kind of impact timelines, then also make it, there better be a reward for putting that risk. Certainly in this time of the cycle where recession is, could certainly happen, and something may happen. Excuse me. So that's the thought on generally what sort of percentages I think you need to be going for in terms of making a deal work or not work. The next point I wanted to bring up is legal ownership of properties. So let's go through how developers specifically work, and we can talk about other projects as other syndications as well. So let's erase. And all right, so the typical structure looks something like this. This is a regular syndication. You have a sponsor entity, and it has a building that it wants to invest in, and it is behind an LLC. And so this is the investment entity. And then investors all invest in that investment entity. And the manager is the manager of that, and is the manager of the investment entity and makes payments is the sponsor entity is now the manager of the investment entity. So the other way to do it, if there's more than one thing going on, is for this to be just an LLC. And then this LLC owns multiple other entities. And so the investment entity itself manages these other entities, and it in turn is run by the sponsor entity. So this is a normal structure of a regular real estate syndication. What happens that's different when we start talking about deals like when we're doing equity and debt, many times my developers will choose to put together a fund in order to build multiple properties. And so what that looks like is instead of these individual properties like that, they'll actually be their own LLCs, and they'll be their own little operating companies. And each one of those entities hires another entity here. And this is the developer entity. So the investment entity itself hires them to be the developer. Now, this is that $500,000 that gets paid out. So it goes to you essentially as the developer, but it's actually going to another entity in order to shield it from, ultimately, we don't want the sponsor entity having any sort of, we don't want the sponsor entity having any assets if we can avoid it. And the developer also has other tasks that are very different than sponsor tasks. It's really tasked with asset management and investor control, and not really as concerned with the developer piece. The developer, on the other hand, is developing the property. So it has the construction components and making sure those pieces are all working, and shouldn't necessarily have any contact whatsoever with an investor, except to the extent that the investment entity really is the one that hired it. So when we're structuring this, what we're looking for is to make sure that if one of these investors gets angry at the project, shielding you as the developer from liability. So this person gets angry, they file a lawsuit against the investment entity. They also name the sponsor entity. Anything beyond fraud, they will not be able to successfully file a lawsuit against you personally. And they would, in the case of a developer, if there's a development going on as well, and they are challenging whether the development itself is in the best interest of the person, they would probably name that developer entity. But the roles are so different that you'd want them in separate entities to protect each other, so you could do whatever you needed to do. Then there's just a simple contractual relationship with that investor, with that developer. And then from there, it it is really just to the extent that the developer and is entered into a contract to help that investment entity. So when one other strategy that many clients are using is this long-term play of, let's see how we do. Let's put it on back on the whiteboard. So on a time, oops. That's a horrible. On a timeline basis, time 0, 1, 2. The development activity itself many times will happen in this first year. Let's say maybe it's a year and a half. And then at the end of that development process, the developer sells. But what a lot of my more successful developers will also look at as an option, if it fits with what their portfolio looks like, is rather than saying, okay, we're going to then have this sell window here, they don't do that. They have a refinance portion here, where at the end of year 2, now they've just refinanced the property. So if it looked like this this deal here, if they refinanced and decided to refinance the whole project for 137, at 1375, they ultimately just need to get enough money to pay off the loan and pay off the return of capital, plus any sort of reasonable proceeds that they would be entitled to. So that the investor would be entitled to. So if they raised just over, that small amount of money, that 13, that probably less than 13 million, in order to, and then could then buy out all of the investors, then they suddenly now are making a much bigger profit, right? So they now have they refinance, pay the investors, and then from this period, at this period here, and we'll write it down below, they own the property. And it has a reasonable debt load on it in order to exist, because they needed to do that in order to pay back the investors and pay off the loan. It's essentially a takeout loan, not only of the construction loan, but also of the investors. And now they've got the property free and clear and can manage it and keep it and count on any appreciation. So if it looks like it's likely to get a long-term appreciation out of this, developers will do that and keep the property for long-term. Now, a lot of my clients are doing it this way, and they have a very, very long time horizon. They just want to build a very large portfolio, and they can do that because the costs out of pocket are much lower in this model. So they're getting paid a reasonable developer fee here, where they're getting paid the $500,000 in order to do the development. And all this extra money is just staying in the property itself and being used. Now they have to come out of pocket some amount of money, but maybe they won't use 20%, maybe they'll use 10% in order to buy into the property. And ultimately they'll have a much greater amount of equity in the end of year 2, and as it continues to appreciate and the loan gets paid down, then they've got quite a nice way to get into a nice asset that they've built, that they know, and can grow their own portfolio very well that way. So that goes through the main topics that I wanted to go through. And I see we have a few questions, so we'll go through those. So if you have any other questions, though, please feel free to put them in the Q&A section there. Let me put this on full screen. All right, 2 questions. We plan to do a public marketing of our syndications, so we go through 506C. Are we required to file blue sky filings for each state we take investors from? I heard 506 preempts the need to do blue sky filings. The answer there is yes, you do need to do notifications to each of the states. So it's easiest if I draw this up. See, I'm a big fan of the whiteboard. All right, so whenever there is, here's my very bad drawing of the United States. We're going to leave out Hawaii and Canada. I mean, Hawaii and Alaska. We'll leave them out. So let's say you're in Texas because it's easier to demarc here. And you've got a property here that you are syndicating. You've got the properties in Texas. You're in Texas. Every one of your investors in Texas. It's really a Texas thing. So under those schemes, then the Texas really has can have the exclusive jurisdiction over how you can do your syndication. When you still have the option, be under the federal rules, to do it as a Regulation D, Rule 506B or Rule 506C syndication, or you could do it as just a Texas syndication and file under their local rules. As soon as you have an investor here in Florida, then suddenly now this is no longer subject to states being able to control it, but must take place under Regulation D. So it will take place under Regulation D, Rule 506B, Rule 506C, and then we are now in SEC. So it's under the SEC. However, while the SEC has now jurisdiction over what it is, each one of these states, so your investors in Texas, your investors in Florida, your investors in Maine, your investors in California, all of these states now suddenly have an interest in protecting their own people. So while they can't make decisions about specifically the regulation itself under the Regulation D, what they can do is they can regulate the sales process that went forward to take place over each of your investors. So they have to accept the Regulation D, but they don't have to, but they can also require that you do these state blue sky filings. And so that each one of the states needs to be notified. Now, not every state needs to be notified. Florida, for example, does not have a notification for a Regulation D, but almost near every state does. The filing fees range from a lot to very, very little. So the lowest I think that's out there is $100. The most that's out there in the main United States is $1,200 in New York, and it's based on where your investors are coming from. So the answer to your question is you'd still need to do the blue sky filing, and it's not really called a blue sky filing. It's a notice of Regulation D for each one of the states. But yes, you should be required to do that. Now, it should be done, really, it takes place right after you do the filing of the Form D. So it takes place almost immediately. And that's part of what we do. I mean, so my firm, we file the Form D. We pretty much immediately file and start notifying for wherever sales have happened, and periodic, excuse me, periodically we check in to make sure that we're up to date on notifying any new states that may have come on board, because you may have filed in Texas and now you need to file in Maine. So then we'll notify the states as new investors come on board. It should not be more. Most of the time, it is not more in terms of fees if it's the same state. So if you've already notified Texas, Texas is a fixed fee state, I believe. And so their fees are already set at, I think, $350. Once you filed there, then you would still notify that more sales have happened there, but you shouldn't need to pay more fees. Second question is if we are required to file blue sky filings when we take investors, is this something we file annually similar to Form D? You don't file. 1 second. So the Form D is filed once per offering. You don't need to make subsequent filings unless there's been a substantial change or if it goes over 1 year. The filing of notifying the states of a sales activity does take place really within 15 days of when it occurred. And most of the time that works out to be, we try and batch it as best as possible just to make the load easier on you. But most of the time you're updating them. So if it's an open-ended filing, or if it's an open-ended syndication that you've put together and your Regulation D offering is less than a year, then your blue sky notifications will also be less than a year, but you need to keep reporting the sales activities as they occur. If it is something where the Form D where the Form D is going to need to be renewed because the sales activity is over a year, then there needs to be a new filings filed with the states as new people come on board. Almost every state requires that a renewal application also be filed, and there are normally filing fees associated with that as well. Good question here. Yes, it is similar to a Markowitz curve. The difference is it's not a perfected portfolio, and net present value is definitely a great way to go, but you need to know what the discount rate for your individual clients are in order to calculate that. Most people have a great amount of difficulty calculating what their discount rate is and don't really know. And so net present value can be useful if there's a way to measure it accurately for them. Then yes. Another question: how can we leverage 1031 into such development syndications? 1031s can fit into into syndications. The challenge is a couple of things. Actually, I'll do another whiteboard. So the challenge of 1031 looks like this. So 1031 is, of course, a like-kind exchange for a set of properties where an investor could take their money from one and do a like-kind exchange, like-kind being the key term, into a new set of property. Now, you have a restriction on like-kind, and there is a restriction on, how should we call it? The nature of the investment. I don't know. It's sort of, when your investor sells this property, right? Takes the cash and puts it into your investment. They can't just strictly put it into your investment in this manner. This would be a realized sale and not an exchange of the same thing for the same thing. The way that it actually works is like this. So they get a piece of the building in a tenant in common. And then the rest of the tenant in common has its own deed and LLC, but this also has its own deed. So your investor here does their sale. They lodge their money with the accommodator here. It funds the purchase of a tenant in common, which is basically the holding of a part of the asset itself, and then it always holds that. Then the relationship between this tenant in common and the investment tenant in common takes place through two pieces that don't really fit well together at all. So there is a tenant in common agreement that spells out the rights and responsibilities of the tenant in common. And the way I typically structure it, through through a non-equity interest in this investment LLC. The reason that we do it that way is to create the rights and responsibilities on the investment LLC and make it so that the 1031ing investor is bound to those as well. So they have the obligations that take place in that structure, and the manager can a little bit easier take money. That said, here's what you have to do is you'll have to get you'll want, not only your securities attorney, someone like me to help you with the securities part of it to make sure it happens, but you'll really need to have a 1031 or tax lawyer in order to help make sure that you're in compliance there. Now, the risk is typically on the investor, not on the syndicator, and it needs to be very well spelled out that that's where the risk lies. So it's doable, but it's certainly very complicated to do. So we plan on acquiring properties using our own equity and then syndicating it out. Okay, perfect. So if our raise lasts more than a year and investors are brought in over the course of that year, do we modify our operating agreement to reflect each investor? Not if I wrote it. The way I write operating agreements tends to be that the investors have one specific class of shares, and then managers have another class of shares, that the operating agreement itself does not get updated really at all with any change of investors. The class of shares is already established for those investors, and then you as the manager just maintain a schedule of those, but it is part of the initial operating agreement, but it's not a long-term updating thing. Another question, follow up on 1031. An investor has proceeds from sale of his restaurants. He wants to come in as a tenant in common my apartment syndication. Is that possible? Yeah, it is. I'm assuming that your question means that the sale of his of retail real estate that is that he's making the sale of. If he's making the sale of the restaurant business, that's a totally different thing. So that's a problem where it is not a like kind investment. And so the challenge there is How do you make it so that they can have some sort of tax protection? That way, the only way to really do it right now is through opportunity zones. And typically there we work, similar to a 1031. We work with tax attorneys who will set up that portion of it, the opportunity fund, and then we'll work on the security piece and make reference to it. And then between the two, you've gotten a mechanism where some tax deferment can take place. Hope that answers that question. But it really boils down to, is it like kind? Real estate and a business are not like kind. If it's retail real estate, no problem. You have the challenges we talked about, but it is at least like kind and has a mechanism in order to do it. All right, with that, we are out of time. So I wanted to thank you for attending this webinar. Again, if you need to talk to me and are ready to get started on real estate syndication or really any kind of syndication or putting together a fund, that's what my firm does. We offer flat fee pricing. But really what my goal as a syndication attorney is I really, really want all my clients to be very, very successful. I will do whatever it takes in order to make sure that they have all the tools that is. And so most of the time, what that boils down to is, yes, we provide the documents and do all of those things, but ultimately our job is to be that person that looks out for your interests, make sure that you're compliant with the SEC and with all the regulations, and also that you have the knowledge and you can get answers to your question to have that confidence that you need to be able to talk to investors, grow your business, and make more and more good syndicated deals or fundraising efforts. So with that, thank you again, and I'll look forward to seeing you on the next webinar.